Hi friends, in this session we are going to discuss about the country's central bank, Reserve Bank of India. Without delay, let's get started. Welcome to my channel Khaja's Academy. The Reserve Bank of India was set up in 1935 under RBI Act 1934, recommended by Hilton and Commission. It was nationalized in the year 1949. First ever governor of RBI was Sir Osborne Smith, and the first Indian governor of RBI was C.D. Deshmukh. Main functions of RBI: issuing currency notes and coins except 1 rupee notes and coins, banker of the government, bank of the banks, monetary policy review, controls inflation, keeping foreign exchange reserves. Monetary policy review. What is a monetary policy review? Simply, we can understand regulating flow of money is nothing but monetary policy review. After all, why this monetary policy? Simply we can understand by some examples. Let us assume that number of buyers are equal to number of sellers, then there will be no competition. In the second examples, buyers are much more than the products available, that is no supply but there is demand, then there will be a possibility for increase in prices. That increase in prices is called inflation. Inflation is bad for consumers, they cannot buy things. And in third examples, there is less buyers and there are abundant of products, there is availability of more products, so it will lead to deflation. Deflation is bad for industries, they cannot survive. So we can understand more money leads to inflation, more products or goods leads to deflation. And to control this inflation by using different instruments is nothing but monetary policy reviews. They are, we go individually, reserve ratios. First one, reserve ratio. What is a reserve ratio? CRR and SLR. CRR means cash reserve ratio, a percentage of banks' total deposits to be kept with RBI in the form of cash. RBI never pays interest to banks for this CRR. What is SLR? Statutory liquidity ratio. Percentage of banks' total deposits should be in the form of securities, gold and bonds. Here I want to mention something. This is a very important point, that deposits of a bank are liability to bank, because banks have to pay back to the customers. So it is liability to bank. There are two types of deposits: demand deposits, current account, saving account deposits, and term deposits. They are fixed deposit and recurring deposits. And second instrument is policy rates. In the policy rates we discuss about repo rate. What is repo rate? Repurchase rate. Rate of interest charged by RBI to banks for short-term lending. It is called repurchase rate. Banks will give some security to RBI and promise to repurchase them from RBI, so it is called repurchase rate. Increase in repo rate will increase the interest rate on loans. In this way, flow of money would be regulated by RBI. And second one, reverse repo rate. What is a reverse repo rate? Reverse mechanism of repo rate. The rate of interest charged by banks to RBI for short-term lending, it is called reverse repo rate. What is the use of these policy rates? Okay, let us assume that some banks have surplus of money, surplus of deposits, then they would give it to the central bank to earn some interest, and the central bank will give loans to short-term loans to banks. Next one, MSF, marginal standing facility. Overnight rate for banks 1% higher than repo rate. Banks would borrow for last resort. What is bank rate? Bank rate is rate of interest charged by RBI to banks for long-term loans. For short-term loans, it is repo rate. For long-term loans, it is bank rate. Base rate is below which the commercial banks should not lend to their customers. That is base rate. MCL or marginal cost of funds based lending rate, introduced by RBI implementing from April 2016. Banks failed to reduce interest rate even after RBI reduces the loan rates. And according to MCLR, banks have to review monthly lending rates depending on cost of funds for loans and rate cuts by RBI. Third one, open market operations. Nothing but selling and buying of government securities by RBI to its clients is open market operation. To combat inflation, RBI sells government securities to banks so that it can suck money from market. To combat deflation, RBI buys government securities. This is how RBI regulates. And finally, to combat inflation, the main instruments used by RBI are increase CRR SLR. Second one, increase repo rate and reverse repo rate. And third one, selling securities to banks. This is called dear money policy because money is very costly here. And to combat deflation, RBI uses three instruments. They are reducing CRR SLR, reducing repo rate, buying securities from banks. This policy is called cheap money policy. Thank you for watching. For more updates, please subscribe to my channel Khaja's Academy.